Joining us to begin the conversation for this afternoon, Brooke Thackray is research analyst at Global X. Brooke, so what's most exciting in your guys' realm is I know you've focused on a lot of thematic stuff over the years after a lot of our leaders got slammed in the sell-off. The question here is what's going to bring us back?
Well, right now, I mean, if you take a look at today's market action, which you were just talking about, we didn't see anything really robust coming out here. It was a mixed day today based on the results. Inflation results were a little bit better than expected, at least on the headline CPI. That should have driven the market higher. I mean, yes, we saw yesterday have a big, huge boost. So maybe it is a little bit of a, digestion period here, but it's not a good sign. We should have seen a full, more of a carryover here with the market here. So I think we might actually start to just settle down with the market here. We saw a lot of volatility last week, obviously with the partial unwind of the yen trade, and a lot of calls for 75 basis point cuts and a whole bunch of different stuff. I think the market's really settling down here. So in this type of market, I do think that. Yes, the Federal Reserve will bring some order to the market here, but I think that I think government bonds are actually a good place to be because the Fed will be cutting. That is expected, of course, but lower inflation, that's good for bonds. We are seeing somewhat of a slowing of the economy, mixed signals there, but overall a little bit slowing, which is also good for bonds as well. So that's where I think the concentration should be.
It's a good point. Something we've talked about here, that it seems like bonds win in like 2 out of 3 scenarios right now, since it seems we're eliminating the reflation scenario, given the weakness of the economy. Then most scenarios, bonds probably win, and that's where the advantage over stocks, I guess, is starting to show up. Because equities, you've got to be real careful, it seems like.
Yeah, because there's no definitive pattern with equities. We're flipping around all over the place here.
That's right.
I mean, it's as it's tech going up. One day it's cyclicals going up the next day. Recently, though, we haven't seen a rotation into the defensive sectors of the market. For instance, not a strong rotation. And just in the last few days, they've been underperforming. If we look at healthcare, except for a few companies, but as a sector, utilities and consumer staples. So we haven't seen that real risk off on the market. Where the market is looking for direction right now. It's going all over the place, but we haven't seen this shift into defensives in this type of market, which means investors still aren't convinced about the direction of this market here, and they don't see it as going down yet. They still see it as muddling higher. If we start to see that shift into the defensive sectors, then that could actually indicate that investors still want to be invested, but they're starting to get concerned. We haven't seen that. We've seen a lot of volatility, but we haven't seen that yet.
It's a really good point. I think a really good analysis there within factors and styles, and I think it pretty much nailed it because we've been flip-flopping since the last CPI rotation and fell on its face. And then since then, we've kind of been grasping. It seems like a few of these secular themes, though, are working out pretty well, like weight loss drugs and like we were talking insurance and, to some degree, more a little safety edge there. But to your point, we haven't really seen like a big defensive tilt. Even some argue the utilities are like a growth play now because of AI. Do you buy that at all?
I do, actually. If you take a look at the relative performance of the utility sector, earlier in the year had that huge run up. It's partly, a play on the whole AI driving up the electrical demand. That's for sure. Obviously, it has something to do with the interest rates as well. But it definitely has increased its beta to the market. You can't go back and look at the previous beta for utilities. It's got a brand new beta because when the market falls, it actually falls along with it right now.
That's great to know. That's great data. I kind of suspected it was going to end up that way when people were hyping it up next to the AI stuff. So it's actually worked out as a sort of beta trade, which is what I think they were hoping it would become. It's just then the beta went the wrong way when we got the market to pull back. So then, Brooke, do you guys track where kind of the rate of change for flows have been? Where do you see people buying the dips across your suite of funds? Because, you guys got a ton.
Yeah, okay, so I'm with Global X in Canada here. We obviously look at across the states and see what's happening there. I don't know specifically as far as the flows into the funds, the portfolio there. But like I said, if we take a look at the rotations, they've been all over the place. Look at small caps. Small caps in July rocketed higher because interest rates went down. So we saw interest rates pull back down. And that trade sort of fizzled out. And if you take a look, small caps have underperformed for the last 3 years, basically, compared to large caps. And everybody go, this is the time. And it's interesting that we're seeing small caps now starting to underperform, even though interest rates really haven't gone back up at all. I think that trade's fizzled. So this is really a time where you want to be cautious. I think you're right. I think it is. You look at specific sectors, very narrow sectors, or very narrow companies that are reporting and coming up with good earnings, or very specific sectors like, let's say, for instance, uranium or something much smaller than a broad market sector. I think that's really what you have to focus on at this time.
Okay. Brooke, on the macro side, since I know that's where your mind is at, when we get the eventual drop in rates that seems like it's really coming, has the sort of bad is good trade for stocks generally expired? It really kind of seems like it's run its course perhaps, but who knows? If the Fed really saves the day, is there a possibility here that you get economic revival if they cut deep enough and the market likes that? Is that something close enough in our timeline to think about at this point?
I think you're right. I think we might actually start to see the inflection point where bad news is actually bad news.
Right.
We've relied on bad news being good news because it meant the Fed was going to cut and drive the market higher. But if we see the narrative switch to a real slowing of the economy concern, then that's bad news. Yeah. So when that bad news comes out, I think the market would react negatively to that. You're right. If the Fed does have an overly aggressive cut, like 50 basis points, I think it would be that threshold. Although I personally don't think that's going to happen, but if it did happen, that could actually drive the market higher in the short term, regardless, and we could see a lift to the market. So, or some strong comments from the Federal Reserve that they were going to support the market or whatever it is. But I think we're on that inflection point right now where we have to be a little bit careful that bad news is actually becoming bad news and the market. Now, the economy is still quite strong, though. I mean, you take a look at GDP growth at 2.8%. So it still hasn't fallen apart. The employment is starting to get a little bit of a concern with some of the factors. The 4.3% employment rate is still good, but we start pulling apart all the different metrics. It is showing some weakness here, but it hasn't fallen apart yet. But I still think we have to be a little cautious that we could be at that inflection point where bad news is bad news. Got it.
Kind of seems like we're hitting that the last couple of weeks. In place, and to your point, going to take something extreme to get us out of it. So, Brooke, I really like the analysis. Thanks for your time.
Thank you.
Good stuff. Brooke Thackray, research analyst at Global X.